हेलो गाइस, वेलकम बैक टू योर सेशन ऑन ट्रिपल ए। कैसे हैं आप लोग?
All good, sir.
ऑल गुड, दैट इज नाइस। ओके, बिफोर वी स्टार्ट kind of start the session for today, any questions, doubts that you guys have?
No, sir.
All clear?
Yes, sir.
चलो जी, perfect. Let me open the text. One small clarification. I think yesterday we were discussing about the risk committee, wherein I said only the non-executive directors are a member. But as per the latest provisions and the syllabus applicable, because it kind of changes jurisdiction to jurisdiction. So as per the latest provisions, both executive as well as non-executive directors can be members of the risk committee. Correct? Majority will be for the non-executive directors. So this is just a small correction from what we discussed yesterday. Under the risk committee, both EDs and NEDs can be members, but the majority will be for the non-executive directors. This is as per your latest international AAA syllabus. Where I think yesterday we were able to just complete the first chapter, the
Yes,
regulation.
sir. Yeah.
Chalo ji. Perfect. The next topic that we have in front of us is money laundering. What do we understand by the term money laundering?
Turning black to white.
Black to white ka conversion. What else?
Converting illegal source into
Illegal money, legal.
Okay. So source proceeds from a illegal channel being converted to a legal means. Of course, you are not paying taxes on that particular money. Anything with respect to terrorist financing as well gets covered under the money laundering provisions. Fair. You all know the ongoing Delhi liquor scam case, Delhi excise liquor scam case. Nahin.
Also.
No,
I
sir.
know you guys are not from Delhi, but itna popular case hai. Our chief minister has been in prison since the past, I think from March or April, he has been in the prison. He is the acting chief minister of Delhi, the capital of India, and you guys are not aware about it. I am sorry. This
And I
is not
believe he's resigning in a couple of days.
He is resigning 2 days, sir. Acha,
okay. So yeah, he has been arrested. So basically what happened is, okay, come a little off the topic, but it is relevant and you guys should be aware about it. So what happens is in Delhi, I don't know how it runs in the other states, but in Delhi, as per the excise laws, liquor is essentially sold under government approved establishments, government approved shops. So if you've seen how a liquor shop looks in Delhi, it is very different to what it looks maybe in Goa. Okay. How it essentially it is you used to find a very dungeon space, not very possibly, good people inside. Very, it was very difficult for a female to go in, enter and buy liquor. because maybe of the crowd that is there inside the shop, maybe the quality of infrastructure that is there, maybe the brands that were available. It was genuinely not a good space. Okay, the alcohol shops were possibly in very weird spaces. If you've seen possibly in Windows movies, you would have seen that there's a small grill like a jail. Okay, that grill is there, and behind that the customers are there, and they ask for the liquor, and beneath the window he passes on the liquor bottle. So that was the old scene. What these guys did was, the Delhi government, what they did was, they introduced a new liquor policy wherein they wanted to kind of enhance the customer experience. And if you guys have seen how a liquor shop looks in Gurgaon, it's so in Gurgaon you have a liquor fort. It's like a, like a Dubai shopping mall. You can't imagine what luxurious stores these guys have. And you can simply go, anyone can go. I've seen, people coming with families, without families, males, females, etc. Anyone can just go in over there, pick up the bottles that you like. This used to happen in Gurgaon. Now, Gurgaon is basically Haryana. So that's outside the Delhi
Sir,
border.
you had cut off when you were speaking.
So he was stuck in between for.
I was stuck in. Just give me a second. Okay. Is it good now?
Yes, sir. You were
Yes.
saying as it was
What
you're
did you
talking
like?
about Gurgaon and how the experience was.
So Gurgaon, it's a part of Haryana state, and it's just neighboring Delhi. There's no physical border as such in middle. You just cross, without paying any toll these days as well. But in Gurgaon, the liquor shops were extremely nice, like absolutely you're walking into a mall, that kind of a setup. So the Delhi government, and there was a price difference as well. So for example, a bottle of black label whiskey is available for 3,000 3,500 in Delhi, and the same bottle was available for 1,800 2,000 in Gurgaon. So that's why what essentially people will do was, they will just go in, cross the border, get the bottle. Though it's not allowed, it's not legal, but you essentially go, you buy those bottles and come back to Delhi, come back to your house. Why would you want to pay more when such, good quality liquor is available at a cheaper price just at the neighboring state? So the Delhi government, what they did was, they kind of brought about a new excise policy or a new liquor policy. Okay. Under the new liquor policy, this entire channel for selling the liquor was privatized. So there were private vendors, very good shops opened in Delhi. All the brands were available. Some of you might be astonished, but there was a buy one get one offer in liquor, as in, you buy a bottle of Black Label, you get another bottle of Black Label free. Even you buy a crate and the other crate gets free. So, and they were competing in terms of the prices and the quality with all the neighboring states. It was somehow the scenario that people from Gurgaon were buying liquor from Delhi. Okay, so that was the change that the new liquor policy brought in. But because, Delhi government does not enjoy the entire powers, it had essentially had to take the permission of the LG, the lieutenant governor, which is of course appointed by the BJP government. So the lieutenant governor said, boss, this policy is not legal. We were not consulted, and you have to withdraw the policy. And then the CBI investigation started, and then the charges of corruption came in together. Okay, that the Delhi government has possibly taken funds from private players to give them contracts to issue liquor and whatnot. And the Delhi government had to kind of revoke this particular policy. Now, a lot of people from the Aam Aadmi Party government, which is in power in Delhi, have been arrested with the case, including Sanjay Singh, Manish Sisodia, and even the acting chief minister, Arvind Kejriwal. He has been behind bars since, I think, March. I think just 1 or 2 days back, he's got a bail. My question to you guys is, he was the chief minister. There are a lot of ministers against which a lot of crimes have been registered. The cases are going on. Why was he not given bail? Why could he not come out from the prison on bail and continue with his government? Continue or not continue with the government is again a different story altogether. but why was he not allowed to come out from the prison?
The laws he was charged with have restrictions regarding bail. I think he was charged for money laundering as or
Yeah, he
something.
was arrested by the ED. So ED generally does not grant bail to these people because they might get out and destroy evidences and things like that.
So I think he had got bail in the ED case, but CBI had appealed that he should remain in custody because for the very thing that he would be fudging the evidences and destroying them. So basically, the CBI won't be having any case against him.
Now,
So that was the appeal, I think, which the court accepted and kept him in the judicial custody.
so
I
sorry, my
think, though.
internet kind of went out, so you'll have to repeat.
Yeah, so I was saying the point was being made that ED, the law, anti-money laundering law doesn't allow bails, but I think he had got bail in the ED case, and the CBI appeal was held up by the Supreme Court, and because he would be out and fudging the evidence against him, and then CBI won't be having any case against him. So I think that was the reason he was given a custody.
Okay. Okay. Anything else? One of the major reasons, of course, there were multiple cases registered, and it's more of a legal battle that you get a bail in one case, you get stuck in the other one. That's a separate story. It was really funny to kind of see the CM. He's already in jail. Okay, ED has already arrested him, and CBI has come in to arrest him inside the jail premises. So I don't know where will they take them after arresting someone who's also already inside the jail, but still. But the main reason why he was not getting the bail was because there were charges under the Money Laundering Act. Okay. They said he was the proceeds that he had taken from this particular, excise policy case, he had embezzled that money and utilized them in the Punjab elections. So Punjab as well, Aam Aadmi Party has been, it's in power. They've won seats over there as well. The idea is, if you are even booked under the Act, PMLA, Prevention of Money Laundering Act, it's a non-bailable offense. Okay. You have to prove that you are innocent. You wouldn't get a bail otherwise. It is such a serious act. Very important for you guys as well, because you guys are accountants, auditors, dealing with a lot of companies, especially if you are dealing with maybe an insurance company or a banking organization or a mutual fund organization where large amounts of monies are involved. Even if you are involved knowingly or unknowingly, you can be booked against the act. Let us say, during the audit, you got to know that your client is involved in money laundering, and you failed to report that instance to the authorities. Still, that is an offense. You can be held guilty. Another example of an offense is maybe, for example, I can say, okay, Tisha is involved in money laundering, but I'm not sure. Okay, I have a suspicion, but I'm not sure. So what do is I start questioning her, because I have a slight idea that she might be, but I'm not sure, and I don't want to report out to the authorities unless and until I'm sure. So what do is I start questioning her, and basis the questioning, she gets a tip off that boss he knows. So tipping off a person involved in money laundering is also an offense. Such a severe critical act. Okay.
Sir, but isn't it better to be safe than sorry?
Okay. The idea is, are you experienced enough to kind of understand money laundering provisions? I know you'll have a slight idea, okay, but there is the chance money laundering is going on. But do you have the full knowledge as an auditor? Because see, technically it is just one chapter in your syllabus. correct? If you talk about otherwise, you're an expert in an accounting standard, you're experts in auditing standards, but are you an expert in a money laundering provisions act? Can you be 100% sure? The
No.
answer is no. Why? Because even if theoretically I might teach you what are the provisions, but you do not have that practical exposure. See, so that is why what these organizations, any organization which, which can be somehow involved in this money laundering, maybe the auditors, maybe the accountants, maybe the banks, maybe very big companies, they need to appoint a money launderer, MLRO, okay, money laundering regulatory officer within the organization, who will basically be an expert with respect to the money laundering activities. Now think about, I am auditing a particular client and I have a slight idea. I'm not sure whether money laundering is going out or not, but I have a slight idea because there is a chance money laundering is going on over here. So what is my responsibility now? Just to report it out to the MLRO. Because that guy is an expert. He knows what the practical scenarios are, where money laundering can take place, where it cannot take place. So my responsibility ends wherein I report the case to the MLRO. Now it is up to the MLRO. He decides whether the case has to be reported out to the authorities or not.
Sir, how do you know the MLRO is an independent person, like his objective, and he's not colliding with the this thing?
Very
Company.
practically, you don't give a damn about it. First, you want to safeguard yourself because you don't want to be involved in such an act.
Okay.
So first and foremost, whoever he is, because it will be well established that this guy is the MLRO, report it out to him. Essentially, specifically, let us say you're working in PwC. So PwC, you will report it out to your seniors. Practically, if I talk about, you'll report it out to your seniors. The seniors knows who the MLRO is within PwC, and then he can take up the investigation part. He can decide whether it has to go to the authorities or not.
So, sir, I do have a question. If the MLRO fails to report it to the further required authorities and fail to report it, so are we still liable regarding it?
Our responsibility ends as soon as we report it out to the MLRO.
Okay.
So,
Then it
So
is up
I
to him.
just
He will take the call whether the case is actually a money laundering case or not, whether it has to be reported out to the authorities or not.
And having an MLRO must be optional, right, for companies?
Specifically for big organization, it becomes mandatory. Those organizations who can be associated with or who can be involved knowingly or unknowingly with respect to these money laundering cases. Specifically, that is why these organizations don't want to get involved with unknown people. Okay. Why do we have these KYC norms, know your customer norms? The banks do that, the telecom companies do that, because they actually want to know who is the beneficiary, who is the person who is actually using the account. You want to be sure, okay, boss, for example, a SIM card, that has been issued on the name of Mr. A, and Mr. A is no longer alive. Unless and until these telecom companies actually go ahead and do that KYC norms on a regular basis, they will not know who the real beneficiary is. Okay, because you have to give in your documents, give in your digital thumb imprint, etc. It can be done at home, it can be done at the local store or what, but at least they are sure that who their real beneficiary of their services is.
Got it.
So can we say that for public listed company it is mandatory?
It will be, essentially. Okay, ji?
Hello.
Yeah.
So just one question. So the MLRO will be someone from our CA firm, or it is an independent entity altogether?
Within. There will be a designated
So,
officer within the organization.
okay.
So
In
I
India,
just had a
even
query.
SEBI is not mandating appointment of MLRO, to my knowledge. Having said, in case of financial institutions, RBI has stipulated regarding the appointment of money laundering officer for certain institution, but it will be coming under the domain of chief risk officer?
Correct. So yeah, any institution which can become part of this money laundering. Specifically, that is why I gave in examples of your banking companies, your insurance companies, your mutual fund organizations. Those kind of organizations have to mandatorily appoint a MLRO. Even those listed companies wherein maybe a lot of transactions are taking place, or maybe, for example, you are raising funds, or possibly, you have a lot of clients at those locations wherein the norms are not very strict. Okay, all of us know the concept of shell companies. Okay, so all of us know the concept of shell companies. Now we know that there are certain jurisdictions, there are certain countries wherein such that it's very easy to go ahead, open these shell companies in those locations and divert the funds over there. Fair. So that gives us a tip ki, okay, boss, here a money laundering can take place. Same is the case with the audit firms as well, especially the big audit firms which are dealing with these listed organizations. They need to appoint an MLRO because, again, who do we report to if we have a tip?
Sir, I had one more question. Like, for example, if we take auditors, there are internal auditors, and also we can, get an external auditor. So doing that would, improve our condition, and the stakeholders would prefer that. So is there something like that for an MLRO as well, or no, just an internal function?
It will see, it is again not the client that has the MLRO. It will be, for example, if you're a part of an audit firm, a big audit firm, so your audit firm will have the MLRO. You will not report it out to the client. Suppose karo, if the client is doing money laundering, you will not report it out to him.
Correct.
What you're doing. It will be within our firm, our entity will report it out.
Okay. So in-house only, there will be like one post for the guy.
Correct. Okay.
If the company is involved in money laundering, will it not impact my audit report?
Yeah. Okay. So of course, audit report, if money laundering is taking place, that means there's a fraud, that means finance is getting embezzled. So that, of course, that aspect will get reported out in the audit report. But that is very secondary because audit report will come in once you complete the audit, have the discussions, get the other misstatements rectified. That's when you will issue the audit report. But as soon as you identify any illicit money laundering activity, first and foremost is report it out to the MLRO. The MLRO will report it out to the authorities.
Okay.
I would just have a I would just put a step, take a step back in this. If there is any suspicious of money laundering, then first we have to ask the management assessment regarding what exactly is the thing before we directly report something to MLRO or to any authorities. Because the first and foremost thing is, if it's a listed company, always the audit committee as well as the risk committee should take the underlying obligation to do the management assessment. Having said, in most recent cases also, there are many failures in terms of complying these provisions. So even if we are an auditor, we should first go back to the management to understand what exactly is the management assessment, rather than concluding ourselves that there is a money laundering case before it has to be taken for reporting.
See, now my point is that as per the provisions of the Act, tipping off the client is an offense. Fair. As soon as you walk up to the management, let us say, you've highlighted 5 or 6 transactions wherein you think that the money has been embezzled, okay, or some illegal money has come in, or it is getting laid. Okay. As soon as you just go in to the management to ask, okay, boss, I want clarity on these 5 transactions. Immediately you've tipped off.
It's
Yes,
not tipping off, no, because our as an auditor, our job is not to identify a transaction and then immediately conclude that it's a money laundering transaction, rather than unless management identifies and then further inquiries moves us towards the direction of money laundering, then only we are responsible.
See, again, I agree with that part.
Yeah.
But then the point is, are you or me, are we expert in the money laundering provisions?
It's not an expertise in the money laundering provisions that we are required to, if there is a suspicious case of thing, because there is a line of demarcation between an auditor and a management. So clearly understanding those demarcations, how can an auditor step in and conclude themselves without management assessment that a particular transaction is a money laundering transaction, rather than getting a management assessment as well as the management responsible for those transactions?
But as soon as you go in for the questioning part to the management, it is equivalent to tipping off. Again, it's a very thin line. Why? Thing that is, it's not, tipping off will not be in writing. Okay. But as soon as you go in and keep on questioning, keep on pestering on specific transactions, which of course the management is aware that money laundering is taking care, immediately what they'll try to do is either hide those transactions or possibly, do something to cover up those transactions. So that is equivalent to tipping off under the legal, the legal setup. As per the provisions, it says tipping off is an offense. So would you want to, for example, you've joined a audit company, you've joined an audit firm, you're a consultant, senior consultant over there. Now you go ahead and keep on asking those transactions once you have a suspicion of money laundering taking place. Instead of doing that yourself, it is always better to first report out these transactions within your firm. You're not reporting out to the authorities. Within your firm, it is better to report it out to the money laundering reporting officer, who will have more expertise as compared to you with respect to what kind of transactions can be a money laundering or not. Then he will study the case further. It is up to him or to decide what evidences to gather, and based upon his assessment, he will decide whether it has to be reported out to the authorities or not.
Sir, so you're saying that if suppose I'm working as an auditor at PwC, so the PwC will have an MLRO.
Yeah.
So what if I'm working in a small firm like audit firm that does not have an MLRO? Who's the second person?
See, as such, that's from a provisions point of view, it's a little less likely because smaller firms do not essentially deal with very big clients, and again, the money laundering taking place in small set of clients it's difficult. Ideally, they should, but it's not a compulsion for them to have an MLRO. Then the best that you can do practically is report it out to your signing partners, and then they can take an effective call. Who do they report it out to?
Okay, sir.
So on whom would the final onus be? Like you said, whether the MLRO is reporting further or not is not really our concern. But then there is a provision, like if I speak in Indian context, there is a provision where the auditor has to report the fraud or he's penalized like 25 crore or something penalties there. And there is a whole elaborate process where you write to the management and get their feedback within 15 days. And if that is not available, you have to report to the central government. So ultimately, whom will the onus be on?
See, two things over here. One is the money laundering aspect. The second is the fraud aspect.
Right.
Okay. Money laundering ke case mein, we are very clear ki boss, we report it out to the MLRO. Then he takes a call whether it is a money laundering case or not.
Okay.
It's his call. But from a fraud perspective, you identify transactions, maybe, it's not a money laundering issue. It is just a, some other fraud that is taking place, some less fraud that is taking place. In that case, your regular discussions will go on with the management. Yes, okay, boss, this is the fraud that we've been uncovered. Maybe the top management is involved. If the top management is involved, you go to the audit committee to discuss those issues. Then you will try and understand what is the impact. And of course, that impact, whether the correction entries have to be passed on, any amount has to be written off, etc.
Right.
Then that will be, of course, well established in your audit report as well.
Okay. So the basic demarcation will be first, like you go to MLRO, he will classify, and then the further course will be decided.
Correct. Okay. Now in money laundering, basically 3 layers that are involved in the money laundering. First of all, it's a conversion of black money to white money. So first of all, you place in the black money. Okay. Then to hide that black money ka transaction, you put in a lot of layers. So it's placement, then layering to kind of hide that transaction. And the third one is integration, where you put the money back into the white circulation. Okay. So 3 aspects: placement, layering, and integration. You do not have to become a part of money laundering in either of the steps. Just ensure even in a layer, because banks, maybe they become part of the layering process. So they have to take care that was suspicious transactions get reported out. Let me just share the screen. Okay. So money laundering, it is the process by which criminal attempts to conceal the true origin and the ownership of the proceeds obtained by illegal means. 3 stages: placement, layering, and integration. What are the offenses under the money laundering? You acquire any criminal property, you conceal or disguise or transfer the criminal property from the country, you entering or being involved in any suspicious transaction to facilitate money laundering. Okay. Axis Bank, you know, in 2016, this was often involved in your demonetization ka case. Failure to report the knowledge or even the suspicion of money laundering is an offense. 5th, tipping off. This is again very critical. This is where a lot of auditors also get involved. Tipping off suspected money launderers about an inspection. So these are all the offenses. Then we have the anti-money laundering program, especially financial services, those businesses dealing in financial. So that is why we have the Prevention of Money Laundering Act 2002, PMLA. Ideally, what do we have to do is we have to have at the minimum, of course, all the organizations have to take the onus to kind of ensure that they do not get involved in such transactions. So you have to do a assessment, basically a risk assessment, that how often or what is the likelihood of your organization to become involved in the money laundering. Your assessment should consider what is the nature scale of the business, what are the targets, what are the types of customers, what were the internal audit regulatory findings, what were the jurisdictions that you've operated in, what is the volume size of transactions, firms, products, etc. Of course, more complex businesses, there's a higher chance of money laundering taking place in a complex business structure. In order to effectively manage and mitigate money laundering risk identified, the firm must establish and maintain written policies, procedures, and controls. These should be commensurate to the size of the entity. Okay. So we need to have a compliance officer, that is a member from the board of directors or a senior management shall be appointed as the money laundering compliance principal. The firms, that is you guys, must appoint a nominated money laundering reporting officer to receive suspicious activities. It is the responsibility of the MLRO to assess whether such suspicious activity shall be reported to the regulatory authority or. Okay. Employees within the firm must identify, assess the level of skills, knowledge required to prevent money laundering. Regular training should be carried out so that you're able to identify suspicious activities. Then again, we need to have an independent audit function to assess the effectiveness of the anti-money laundering controls.
Sir, if the MLCP and the MLR were different, what would be the difference in their work? Like, how would they deal with transactions?
There's no as such clear demarcation as such, more or less on the same lines. it can be the same person, it can be a different person, but then both of them will be together jointly responsible to assess these transactions.
Okay, sir.
Sir, which one of these has more power? Like who
Essentially,
is senior?
it's the same level of roles and responsibilities. That is why they've given you an option. Ki boss, it can be the same person as well.
Okay. Okay.
We have these customer due diligence or know your customer provisions to kind of prevent such money laundering taking place. For obviously high risky clients, you need to kind of check the background of the client, check the purpose of transaction, monitor that regularly. For maybe simple clients, there's a low risk potential. Okay. So for example, even there are cases if, for example, you are running a business, you are raising finance and someone invests money in your organization. Because that's an investment, that's an equity, that's not taxable, but that means that money is coming to you. So you should know from whom you are raising those funds. Okay, are these proceeds coming from illegal sources or not? Where members know or suspect that the funds or proceeds of crime or relating to terrorist financing, they should request that the MLRO promptly report their suspicions to the relevant authority. Some examples of suspicious transactions: large cash transactions, frequently swapping different currencies, excessive use of shell companies for no business purpose. These are all examples that there is a chance that money laundering will be taking place. There is an agency known as FATF, Foreign Action Task Force. Okay. FATF, it's basically an international body that kind of regulates these money laundering transactions, okay, across nations. Because see, MLRO, it's still on a national basis. How do we identify international transactions? So there's a body known as the FATF. Now, FATF issues lists, okay. We have the white list in terms of these are the safe countries. No such issue if let us say you're investing money in any country which is being targeted as a white in the white list, that's okay, your funds are safe. But then there are certain countries in which are categorized under the gray list or the blacklist. Gray list is कि boss यहाँ पे ना this country has some kind of a terrorist financing or a money laundering issue. So there is a higher risk that your money will not get recovered. Basic samanda, if I'm investing money, what do I want is I want an adequate return. Okay. Sometimes I'm not getting a good return in my country. I am investing funds in some foreign country. So I want to know which country is safe to invest. So FATF is issuing lists. Okay. Very quickly, just search the internet. In what list does India fall? White list, gray list, blacklist.
So like
White
OFAC
list.
and UN sanction list, or is it different than that?
Sorry?
Is it like OFAC and UN sanction list, or is it different than that?
I think it should be FATF. FATF, just search FATF gray list or what.
Okay.
So FATF is like a regulatory body, like every country has one different one, or no?
Centralized.
Okay, only one body
One
in the
body.
world, only one. Okay. And
Obviously, it's got a higher dominance from the West.
It's not
Okay,
there on the
but
black and gray list, sir. So I guess white.
it's not there in the black and gray.
No.
What about Korea?
Korea is in the blacklist.
Blacklist, sir.
The North Korea.
North Korea is there, Iran is there. Not very shocking when US is deciding who gets to be on what list. But yeah, let me just share the screen for you. So I've opened the website. So these are the high risk jurisdictions. We've got Myanmar, we've got Iran, we've got North Korea. Okay. Then we have the gray list as well. Bulgaria is there, Cameroon, Croatia, Congo, Kenya, Mali, Mozambique, Nigeria, Philippines, South Africa, Syria. Okay. It was very shocking, but essentially Dubai as well was a part of the grey list. Very recently, it has been removed. Even Pakistan was a part of the grey list, but backdoor talks and everything, it's kind of been removed after they've frequently they've taken steps to remove those terrorist activities or so. So that is got removed. But the idea is that if you are a part of this gray list or blacklist across FATF, it becomes very difficult for you to raise funds. Any country that wants to run its budget, either it is raising funds from taxation or from possibly issuing loans, taking loans from the international market. Now, for these countries, taking out a loan becomes very difficult. Why? Because you're not dependent. Okay. Or if possibly someone is giving you a loan, it will be at a higher rate of interest because the risk is more. So obviously people will need a higher set of reward for giving you loans.
Sir, as an auditor, what will be the consequences of this list?
As an auditor, see, a very simple consequence is you'll have to see that was how exactly your client is dealing in. If he is frequently dealing with certain companies from these set of countries, the chances of money laundering increases.
Okay.
Okay, because less amount of jurisdiction over there. There are higher chances of terrorist financing, money laundering taking place in these countries. So if your client is dealing with companies associated with these regions, higher chances of money laundering taking place.
Okay.
All clear? Any questions, doubts in this?
All clear, sir. So I just want to ask that 1 second, sorry. Yeah, so you skipped a few points in the Zell book, right? So are those like not important ones, or are we gonna come back to them? Just some clarity on that.
It's something that we've already discussed in class, so you can just possibly read
Okay.
through. If you always feel that that this is any one pointer that you haven't understood, so we can discuss that again. So it's often, I don't want to kind of just make it very boring and going through each and every line. If something that we've discussed, there's no point in just going ahead and reading. You can read it on your own. Any questions, doubts you have, we can always come back and discuss it.
Okay, thank you.
So if this money laundering comes out after we have issued the audit report, so there will be any impact on the auditor then? Because we are giving reasonable assurance, right? We don't know.
So you have to display that, boss, you carried out your work in a well-established manner. You properly planned. That means your planning will be documented. You collected all the evidences which substantiate the kind of opinion that you have issued. Okay, you have done your work as per the standards on auditing. And still after that, you could not uncover these fraud or fictitious transactions. So you will not be held guilty of misconduct. Okay, it's still a very rare chance that money laundering is taking place, because see, money laundering, I'm not talking about a small transaction. It's not a 5 rupee or a 10 rupee or a 500 or a 1 crore transaction. It's obviously
Yes.
transaction that we're talking about. So it should ideally come up as a sample to you. Because when I agree that if there are 100 transactions in a company, you do not test 100 transactions, you possibly test a sample of 20, 25. But there should be some logic in that sample selection as well. On what basis have you selected the sample? Okay, so ideally, but still, if you've done your work as per the standards on auditing, you are not held guilty of professional misconduct.
Because if someone is doing money laundering, they will be planning it. And
They will hide.
yeah, and big companies, they are doing transaction in millions already. So it might be difficult, right?
Okay. One of the first standards on auditing that we are discussing. ISA 250. Auditor's responsibility towards compliance of laws and regulations. Okay. See, any company that gets formed, there are a lot of laws that are applicable to any particular business. It can be, let us say, the environmental laws. It can be the Factories Act. It can be, employees union. It can be provident fund rules. It can be income tax regulations. It will be the company's law. If it is registered, then the securities board law. Fair. And then along with that, carbon emissions law, n number of laws and regulations that are applicable for any particular client. Do you think for you as auditors, you are experts in the accounting standards and maybe the company laws and the securities listing, the finance part, but do you think it will be possible for you to be aware about the provisions of all the laws? Right? So whose
Not required.
responsibility should it be to ensure compliance to laws and regulations?
Only relevant laws and regulations.
Could be the management.
Yeah. First and foremost, at the base level, it will be the management's responsibility to ensure compliance with laws and regulations. Okay. But I cannot say that the auditor has no duty over here. So what I do is I divide the law in two parts. Okay. I say, boss, there are a set of laws which have a direct impact on the financial statements. This covers your income tax regulations, your company's acts, your accounting standards. Okay. So laws that have a direct impact on the financial statements, and the other is the laws that do not have a direct impact on the financial statements. For the first set of laws which have a direct impact, the auditor has to collect evidences that the client has complied with these set of laws. Okay, that means more procedures to be carried out to ensure that those laws which have an impact on the financial statements have been complied with. Clear? And less work with respect to those laws that do not have an impact on the financial statement. This will, of course, if you do not comply with these laws, there will be some fines, penalties which have to be paid. But it's not in your onus, or possibly it's not in your power to ensure that all the provisions are getting complied with. Fair. So we divide the auditor's duty into two parts. One is the active duty, one is the passive duty. Active duty for those laws that have a direct impact on the financial statement. Passive duty for those laws that have an indirect or do not directly impact the financial statements. Clear? Okay. So we basically divide into two parts. One is a direct impact on financial statements. Second is no direct impact. Over here, we'll mention active duty. And over here, we'll mention passive duty. What do I mean by the term active duty? That boss, you will collect evidences to ensure compliance, to see whether any non-compliance has taken place or not. And over here, it will more so not be much inquiry. So majorly what you'll do is you will conduct inquiries from management. So basically what you can do is you can ask the management if there were any visits or if any non-compliances has been there, any fines, penalties have been paid with respect to such particular laws. Your example over here can be, let us say, income tax, companies law, SEBI or securities law, listed organizations के ऊपर जो भी law होता है, your accounting standards, okay, and यहाँ पे it can be, let us say, the environment law, the what do you say, factories law, carbon emission law, those kind of laws. Okay, so that is what the text is saying, that first it is the responsibility of the management along with those charged with governance to ensure entities' operations are carried out with respect to the relevant laws and regulations. It includes that all your liabilities, expenses are not misstated. So you will ensure, the management will basically ensure that they know what the requirements are. They publish the code of conduct, ensure that employees are also aware, they are thoroughly trained with respect to the code. They will monitor the compliances, engage legal advisors, maintain a register of laws that are applicable.
So could you please move top like to the flowchart part for 1 minute?
Sure.
So what is that part under passive duty, just above passive duty? What is written? No direct?
No direct impact on financial statements.
Okay, so for that only inquiry is enough.
Majorly, yes, we conduct inquiries from the management.
Okay, yes, thank you.
Most welcome. Responsibilities of the auditor. The auditor is not and cannot be held responsible for preventing non-compliances with laws and regulations. However, they must respond to the cases that are detected. Maintaining an awareness of such laws and regulations by the auditors for their clients is obviously a challenge for auditors, especially if the client attempts to conceal that. So what we do is we basically divide it into two. One is that have a direct impact on the financial statements, and the other is the instances of non-compliances that may materially affect. There's no direct impact. So if it has a direct impact, what do you have to do is you have to obtain an understanding of the compliances that have to be made, inquire the management about the policies to ensure compliance, inspect correspondence with the legal authorities, apply procedures to identify non-compliances, obtain written representation from the management and those charged with governance. So in a way, what we are doing is we are collecting evidences to ensure compliance.
So when we say auditor in this aspect, we cover both the statutory auditor as well as the internal auditor here, is it?
We are talking only about the external auditor, that is your statutory auditor.
Okay, not the internal part.
No.
Sir, You said we're just talking about the statutory auditor. So is it like just specific to this one, or in general in AAA we'll be talking about only the external auditor?
So until and unless I clearly call out that these are the duties of an internal auditor, we are talking about the statutory auditor only.
Okay.
Okay, because the idea is he is the one who is signing off on the financial statements. He is saying that the financial statements are true and fair. Some examples wherein you might have a indicator that a non-compliance is taking place is, for example, there is an investigation going on the company. Okay, or possibly the company has paid certain fines, penalties. So you will go back and question the management for what have we paid the fine? What was the non-compliance? Have we rectified that non-compliance or not? How are there any other regulations that we are not complying with? Okay. Management has paid something to a consultant. Maybe they've paid to the government employee. Understand what is this payment for? It's an indicator that a non-compliance is taking place. Okay. Excessive commissions being paid for sales, purchase. So those are what? Those are nothing but dummy transactions that the management has passed on. Okay. Management has significantly started purchasing goods at maybe above or below the market price. Maybe there's a new vendor with it, which is, the management is purchasing goods at a very high price. That means there can be dummy transactions which have been going on. Unusual cash transactions, especially with companies situated in tax havens, those countries wherein the tax rates are relatively low. Payments for goods and services made to the country other than the country from which the goods or services originated. So for example, you purchase certain goods manufactured in Bangladesh, but you've paid out to companies in Nepal. You have to understand why such transactions are taking place. Payments without proper exchange control documents. So you know that whenever you are paying or making receipts or payments in foreign currency, the FEMA, Foreign Exchange Management Act, also gets applied. So you'll have to ensure documentation with respect to that. Existence of an information system that fails, whether by design or by accident, to provide adequate audit trail or sufficient evidences. It's a very critical point. See, because by information system, I basically mean a computer system. Let us say the management is recording the transactions in a sales system. Okay. Now, this sales system, obviously, whatever the revenue or the total sales are, will get recorded in your financial statements. Correct? But just think about that this sales system is only recording the amount. And it does not record who the customer is. Details not available. So that's a suspicion. Why are these details not available? These are all what? These are examples that certain non-compliances may take place. What happens when you identify a non-compliance? First of all, check what are the talks that are going on with the regulatory authority. Okay. Inquire from the management if there are any penalties that have been imposed, because if there is any penalty, so you will need a provision. If not, if you're not sure, then still a contingent liability might also be involved. Obviously, these matters will be discussed at the board meeting. So you will take the minutes of the board meeting. What do I mean by the minutes of board meeting? See, if, for example, we are the board of directors of a particular company, any discussion that we do will be written down as minutes of the board meeting, and it will be circulated to everyone that in this board meeting, these are the pointers that were discussed and everyone has agreed on this action plan. So the auditor will obtain minutes of the board meeting to see what points were getting discussed. Then inquire with the compliance departments. The company will have a legal department or a compliance department, you can understand how are we exactly preventing such non-compliances in the future. If you uncover a non-compliance, okay, you identify, okay, boss, there's a particular law that is not getting complied with. First step, Anand, what you were saying in money laundering, this is what the correct step will be, and this will be applicable to the normal non-compliances. First step is discuss that issue with the management and those charged with governance. Okay. Ask them why the non-compliances are taking place. Check whether they have started complying it or not. Second step, if you think that it is intentional and it is material, something important, something worthy, then report it out to those charged with governance. Suppose you feel that those charged with governance is also involved. So what you do is you report it out, report the matter to audit committee. The difference is over here, essentially, this is the executive part, and the audit committee will only have non-executive directors. Okay, so you should involve the audit committee in this case. Obviously, it will have a direct impact on your audit report. In the audit report as well, you will highlight this non-compliance. And if it is a case, if it is mandatory for you to report it out to the government, then you will also have to, if obligated by laws and regulations, then you will have to report the matter to the government or relevant authority as well.
So those charged with governance, this is basically the board members, or like,
so
well,
it's not defined as such, not just the directors, because if we specifically define that, okay, only the directors are those charged with governance, what the companies will do is, because they'll make dummy directors, but retain the controls with someone else. So that's why we haven't defined the term those charged with governance. Anyone who is taking decisions for the company, the day-to-day decisions for the company, senior management, maybe he's not a director, but let us say he's a CFO. Okay. So he will also become a part of those charged with governance.
okay. Makes sense.
Hi. It might be a silly question because as we are reading through it, I'm relating it with my industry. So first we talked about, like, we are referring to financial and non-financial, both we have to take care of, right? Then because the auditor does not know all the compliances of the specific industry, we will go, if we have paid any penalty, then he will go back to the management. But if there are any compliances which are not followed and are not affecting my financial statement, then what we will do? It comes under our role, or like how?
See, something that is not impacting my financial statements, there has not been any fines or penalties being paid out. So my job is just to see the numbers, just to see the financial statements, whether that is true and fair, what is getting reported out, and sign those set of financial statements. Then that non-compliance does not essentially cover in my scope. But talk about, let us say the company has been, maybe they've not officially paid a fine or penalty, but they're kind of giving out unusual cash transactions. Okay. And I do not question them. Then that gets covered in my scope.
So if it is financial only, then it comes under our role. But like yesterday we talked about, like an auditor has to cover financial and non-financial both.
Okay. See, two sets of auditors, external as well as internal auditor. Okay. Now the external auditor's job is to do what? To just see whether the financial statements are true and fair. Okay. Apart from the external audit that goes on, the company can engage the auditor in several other roles as well. Over there, he can check both the financial and non-financial data. So yesterday, what I spoke was that from an audit perspective, I can audit the financial statements. I can also audit non-financial data. Okay. But when I have been engaged to act as only as an external auditor or a statutory auditor, I am only checking in the financial statements.
Okay. Thank you.
Most welcome. Yeah, Anand.
I think I would just like to point out to the question raised by our team member. In terms of indirect loss, if there is no financial impact, but if it is going to have an impact on the operations of the entity, yes, obviously it will come under our domain. More likely it may have a characteristics like impacting the going concern or anything, if there is any legal and constructive obligation. So definitely indirect loss, all indirect loss may not be directly applicable or relevant from a financial statement standpoint, but those laws which are going to have an impact on the operations, definitely we have to look at and factor it in our auditor's report.
Thank you, Anand.
Everyone is clear on it. Okay. So this was ISA 250. Now, basically, anytime the ACCA body would recommend you to not be associated with people who lack integrity. Okay. Whenever we go in for an audit, we have that presumption that, okay, boss, my client is an honest guy. That's my basic presumption. I do not go in with a setup, no, boss, he's a guilty guy. I think that, okay, boss, he's an honest guy and I believe whatever he's saying. Accordingly, my approach is very simple in terms of the audit. I collect the evidences, give a sign off. But, you identify certain non-compliances. That means that your client now lacks integrity. So what you've done is you basically ask him to go ahead and comply with those laws and regulations. Let us say your management refuses. He said, boss, go to hell. I am not complying with any of it. Okay. Now your outlook to that client will change. Okay. And the ACCA body or any governing body for that matter would not want you to be associated with people who lack integrity. Maybe that's a small non-compliance for now. Maybe if you integrate, kind of correlate this or aggregate this over the years, or possibly there are chances there are other non-compliances as well, which you haven't identified. So it can be a big case. And ultimately, your firm's name will go in for a toss. At the same time, the ACCA body's name will also go in for a toss. Everyone will say, boss, ACCA body members do not know how to do an audit. Okay. So for example, when the Satyam scam took place, PwC's reputation went for a toss. 2 directors were jailed. At the same time, ICAI was also questioned. The Institute of Chartered Accountants of India was also questioned, boss, what quality of members are you bringing in? How are you regulating the profession when such a big fraud was taking place? Okay. So the idea is, boss, if you feel that the management lacks integrity, they are not willing to budge at all, and the national local laws allow you can disassociate yourself from the audit, resign from the audit as well. Okay, so if you have that option available based upon the local laws, jurisdictions, if there is a possibility for you and the management is not at all complying with the laws and regulations, you can resign from the engagement as well.
All of us can relate this with the change in auditors in the Byju's case, where Deloitte moved out and BDO came in with a lot of things going in the back end regarding the laws and regulations compliances, especially from the US perspective also. So everyone can have a direct relationship with a classic example of change in auditors in the recent case of Byju's. But if you go back, you can see enough histories of change in auditors whenever there has been a aggressive management position.
Absolutely. Absolutely. I agree. I think that's a very classic example because Byju's, it wasn't a new case. This was a repetitive scenario that was coming in. Every time they were not filing in their accounts, every time there were delays, every time the management was not budging in, and they thought that it will just go on. The auditors can also support you till a certain level. Okay. Even they have a reputation. And see, essentially, why do we employ the big fours as auditors? Why do we say just, go ahead and, hire PwC, EY, Deloitte, KPMG as auditor, maybe GT now as well. That's got a very big brand name in an external audit. But why do we do that? Because it's not that, someone else will audit that there will be a less quality or they are not competent enough. But when I am raising funds for my company, the banks will read the audit report. Okay. They should recognize the person who has audited it. They should recognize the brand name of the firm that has audited your financial statements. If the bank manager does not know who has audited it, you say, okay, boss, ABC and Associates is my auditor. They will not trust you. They will ask you to get that audit done again from maybe some other company for some other firm. Okay. So because that brand name is such, if for example, I'm raising funds from maybe UK market or US market. Now PwC, EY, they are well known over there as well. So when they read, okay, boss, the financial statements are such, and this company, this particular firm has audited them, there's a level of trust on those financial statements. Okay. And that's the onus. Why we are saying is that the auditors have an option to resign. What will happen? If I resign during the year, questions will be raised. The management has to file the accounts. They will need some other auditor to come into the picture. Correct. So suppose, during the year, I resigned and the management came ahead and hired Anand. Okay, boss, now Anand, you get hired for my auditor. Before he starts his work, it is his professional duty to come in contact with me, ask me the reasons why I left. Even when I'm resigning, I will circulate a letter to the shareholders stating the circumstances of my resign. So even though I'm not issuing the audit report, still that issue is coming to light. No other auditor will get associated with a company which is not complying with those provisions. That's the basic idea why we are saying is, boss, you can resign from. It's not that you resign, someone else will sign in. It is his professional duty to get in touch with me. I, of course, with the permission of the client, will send you the documents during the year which we've collected, and I will tell Anand, okay, boss, these were the circumstances basis which I resigned. Now it is his call whether he wants to accept that kind of a auditor as that client for that year or not. So I think, yes, that's all about ISA 250. Just very quickly, I'll show you the table as well for your clarity. So the auditor may consider withdrawal from the engagement management if the management and those charged with governance do not take any remedial actions. The non-compliances raises doubt on the integrity of the management. So what you have to do is obtain a general understanding of the legal framework. If non-compliance is discovered, obtain further understanding, evaluate the impact on the financial statements, consider withdrawal if the client refuses to cooperate, and report it out to the appropriate level of management or higher. Any questions, doubts? Chalo ji. Perfect. Let's take a quick break for lunch. It is 3:20, 3:50. We resume the session for the remaining part then. Cool.
Okay, sir.
Okay, sir.
Okay, sir.
Anji guys, we are back.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Perfect.
Yes, sir.
Yes, sir.
मैं समझ गया आप आ गए सब लोग एक एक करके यस थोड़ी बोलोगे. Okay. Coming back. We have another concept. So abhi we discussed about ISA 250. Now we are talking about ISA 240. Auditor's responsibility with respect to prevention and detection of fraud in an audit of financial statement. Okay, fraud se related, what are the auditor's responsibilities? That is ISA 240. Okay. Ultimately, whose responsibility it should be to prevent and detect fraud?
Management.
Management.
WGN.
Everyone.
Management.
Perfect. So commensurate to the size of the business, the management has to put in controls that prevent and detect fraud from taking place. Okay. But auditor ka kya responsibility hai? Auditor is doing nothing, but he is obtaining a reasonable assurance that the financial statements are free from material misstatement. Okay. In this definition, when I said reasonable assurance, so that financial statements are free from material misstatement. What do we mean by the term misstatement?
Galti. Like
Errors
Galti.
which can have a
mistaken.
material impact on the
Material.
FS.
Okay, perfect. So this galti or the misstatement that we call about, it can be intentional or unintentional. Where it can be
Yes.
intentional as well as unintentional. When it is unintentional, we term it as an error. And when it is an intentional one, we term it as a fraud. So by definition, both error and fraud are getting covered over here. Okay, because again, by definition, auditor's responsibility is to obtain reasonable assurance that my financial statements are free from material misstatement, whether caused due to fraud or error. Okay. So to uncover, to ensure that to obtain this reasonable assurance, what will the auditor do? He will basically conduct procedures. He will conduct audit procedures. Okay. At the same time, he has to maintain professional skepticism. When I say professional skepticism, it means having a questioning mind. Do not accept things at the face value. Have a questioning mind. So he has to maintain professional skepticism that in cases of fraud, the management might have tried to kind of hide those fraudulent transactions. Okay. So the normal audit procedures might not be able to uncover all the fraudulent transactions. Good. Basic idea. Again, will the auditor be called out guilty of professional misconduct if in case he is not able to detect fraud? The answer is as long as he is working as per the standards on auditing, he is documenting everything, his planning, his procedures, he is not guilty of professional misconduct. Okay. His responsibility is to obtain reasonable assurance that the financial statements are free from material misstatement. Misstatement, of course, will include both your fraud and error. He has to maintain professional skepticism for the indicators of fraud. Okay, so what I'm trying to say over here is, might get a little confusing, but not my responsibility to 100% detect fraud. But as an auditor, I should be able to identify what are the risky areas. I should be able to identify what are the indicators of fraud. Okay, what are the areas wherein a fraud could have occurred? So for example, I am conducting the audit of any company. Okay, now I know over there in that company, the controls are very weak. No one is marking the attendance. Anyone can make purchases. There's no signing authority, no approvals required for the purchases. So the controls are weak. Do you think there is a higher chance of fraud taking place? Obviously, yes. Why? Because there's an opportunity for fraud to take place. Same ways pe, there can also be incentives for fraud to take place. So for example, it's a very high pressure environment. Okay. The management is forcing you guys to kind of go ahead, meet the sales target. There's a lot of pressure from the top management. Employees are really dissatisfied. So that creates an incentives for the employees to basically commit fraud. And last is the attitude that, if both incentive is there, opportunity is there. If I don't have an attitude to commit fraud, I will not commit fraud. But if I am a person who lacks integrity, no matter how many controls you put in place, I will always try to commit a fraud. Cool. So the auditor has to be very clear about, okay, while testing those transactions, while conducting the audit, what he has to do is he has to identify whether there's any incentive, opportunity, and attitude. If yes, that is an indicator of fraud taking place. And if I have an indicator, I will obviously do more testing. Okay. Let me I'm kind of going ahead from the syllabus, but this will actually help you to understand things better. How does an audit cycle work is, first of all, the auditor gets appointed, or possibly you can say acceptance for the audit. Okay. Once he has accepted that, okay, boss, he will conduct the audit for this particular company, then comes the planning phase. Okay, so he will make the audit plan. How do I want to basically audit this particular entity? Here, he will try to understand. See, at the planning stage, before actually going ahead and just starting with my audit procedures, I would want to see what are the risky areas. When I say risky areas, what are the areas where a misstatement can occur? This misstatement, now that this will include both your fraud and error. Fair? So I will try to understand from the management what are the risky areas, those areas possibly where the controls are not there, or some think about management has started a new line of business. So that means the risk will be higher over there. There is a particular set of transactions which are cash based. So the risk will be higher over there. There is a set of, transactions wherein we interact with the local government officials. So again, that's a risky area. So what I'll do is I will assess where exactly the risk of misstatement is higher. And based upon my assessment, I will ask the management, ki boss, do you have any internal controls? What exactly the controls will be? They will try to mitigate the risk. Okay, because as an auditor, I will come in and highlight, okay, boss, these are the risky areas. That means there's chances of fraud. But the management will tell me, don't worry about that. We also have conducted a risk assessment and we have put in control. So for example, review of procedures is one control. Having authorizations in place is another control. Ensuring board minutes get documented, that is another control. Marking the attendance for employees, it's another control. Documenting any orders, let us say sales orders getting received and ensuring that they get completed, that's another example of control. So management will tell me what are the different controls that are there within the company. Now what I will do is I will test the controls. Okay. Based upon my testing, whether the controls will be effective or either the controls will be ineffective. If the controls are effective, what should be my sample size? should I select a higher sample or a lower sample? When I say the controls are effective, it means that it's a strong control environment.
So, but selecting of samples is done at the time of testing controls, right?
Okay, just give me 1 minute. I will explain it a little better. Yeah. Done. Okay. See, first of all, I have accepted to become an auditor. Then I start with the planning. I identify what are the risky areas. Okay. Based for the risky areas, the management will tell me what are the controls that are there in place. Okay. Till now, I haven't tested the transactions at all. I haven't conducted any audit procedures. First of all, what I would want to do is I would want to see whether the management's controls are operating effectively or not. For example, the management says, "Ki boss, we record the attendance of all the employees on a daily basis." Okay. So I will call out for the attendance registers and check in the attendance. I can possibly match that attendance with the salary records. So I would know whether the controls are effective or not. Okay. If the management's controls are effective, that means higher chances of fraud or lower chances of fraud.
Lower chance.
Lower.
Obviously,
Lower
because
chances.
strong control environment, management has put in controls and those controls are operating effectively. So that means lower chances of fraud. So that means I can also reduce my sample testing. However, if my internal controls are not effective, management had said that they taken the attendance, but my attendance records do not match with the salaries being paid. That means that the controls are not effective. It is a very loose control environment. Don't you think that I should test more transactions to uncover fraud because there is a higher chance of fraud taking place over here?
Yes.
Yes.
Okay. So see, that is the idea. We don't want to stick it to theoretical. Very practically, you are conducting an audit of any company. You go ahead, you plan that particular audit, you see what are the risky areas, you test the controls. When are you testing the controls, you will identify what are the chances of fraud taking place. If it is a strong control environment, less chances of fraud. If it is a very loose control environment, the controls are not operating effectively, higher chances of fraud. If you feel as an auditor, there is an indicator of fraud. So for example, ineffective controls is an indicator of fraud. So if there is a higher chance of fraud taking place, you will have to kind of increase your audit testing, your audit procedures. Any questions, doubts?
No, sir.
Perfectly. I'm still not using the, the core audit words or jargons because I want to kind of slowly introduce them during the discussion. At least it's still the second class, but on a simple terms, we've understood the logic.
So, sir, according to the control are being placed, so the materiality and performance materiality is going to increase or decrease according to the how the control procedure are there, right?
You're saying the materiality, will it increase or decrease?
According to the process, how the controls are being placed, are they are strong, so materiality will be high, and the performance materiality will be also high. Obviously, no.
So we're not talking about performance materiality as a concept right now, but materiality, because we haven't discussed that in detail. Materiality basically means something that is of value. For example, if you're testing in, let us say, Reliance Industries, so a transaction worth maybe 5,000 rupees or 50,000 rupees or even 5 lakh rupees might not be material because the turnover of the company is thousands of crores. Correct. So if you say ki boss, 5 lakh rupees ka, it's been stolen. It's not material. It will not impact the decisions of the shareholder. A shareholder will not start selling shares basis this piece of information because it is not material. So what we do is auditors, obviously, they are more so concerned with material amounts that are of higher materiality. We define materiality as a percentage of maybe revenue, profits, assets. Okay, we'll discuss that later. We have an entire standard on materiality. So, but when do we decide what is the material amount? At the start, planning stage, we decide, okay, boss, for this particular company, all transactions rupees, let us say 1 lakh is material. Okay. Now, during the audit as well, if we feel that no, boss, the materiality threshold should be changed, we can do that. Okay. Not relevant as of now for you guys. Those who have not understood, you can just shush that concept away. It's not for you. Anyone who knows about materiality will have understood this concept. Auji, we are coming back. Let me share the screen again. So it is ISA 240. So any breaches to laws or regulations, any fraud or error, or any ineffective controls are all termed as irregularities. But what do we essentially talk about is misstatement. Misstatement can arise either from fraud or from error. Misstatement definition, it is not very important. We will discuss that at a later stage. Fraud, ISA 240, this talks about the auditor's responsibility with respect to fraud in a financial statement. It basically says what is fraud? It is an intentional act. Okay. Maybe the management is involved, maybe those charged with governance are involved, maybe employees are involved. But the idea is that either of these two things have taken place. Either there is a fraudulent reporting. Okay, you have increased your assets, you have increased your revenue. When I say increased, that means overstated revenue or overstated your profits and tried to reduce or understate your liabilities. That's a fraudulent financial reporting. Second is misappropriation of assets. So for example, using the company's assets for personal purposes. That's a misappropriation of asset. The examples have been given in over here. Posting dummy entries in the books of accounts, concealing material facts or figures from the financial records, greater emphasis of performance-related remuneration. So senior management getting more or higher bonuses than what is getting recorded. Finance providers, when making lending decisions, rely basically on the financial statements. So directors might want to try to make the books of accounts more attractive. Then three things that should be present. There should be incentive, opportunities, and attitudes. If, for example, your company is not financially stable, there is a lot of, pressure to meet financial targets. There is a pressure from the management to meet the expectations of third parties. These are all incentives. These are all areas which kind of trigger you to commit fraud. Opportunities can be maybe, it's a very complex organization structure. There are a lot of related parties which kind of transfer inventory and funds among each other. There are lack of internal controls. These are all examples of opportunities. Attitude is basically, lack of morale among the senior management. The management and the auditor are not, they've got strained relationship. There's a violation of laws and regulations. Basically, the attitude of employees is not, it lacks integrity. Misappropriation of assets basically means embezzlement of receipts. So for example, you've received money from A, but you've recorded it in the books of Mr. B. Physical assets, you've stolen it from the factory premises or office premises. Payment of goods for which no delivery was taken. Use of entities' assets for our own use. These are all examples of misappropriation of assets. So maybe you do it for personal benefit. Maybe there's an adverse relation between the employees and the company. There's too much pressure from the management to meet the expectations. These are all incentives. Opportunities can be the company deals in cash a lot, very high number of transactions without proper documentation, very complex organization structure, lack of internal controls. Attitude can be, breach of existing controls, failing to correct existing deficiencies. These are all indicators that the attitude of employee is not correct. When all of these parameters get met, there is an incentive, there is an opportunity, and there is an attitude problem. That is when a fraud will take place. Ultimately, primary responsibility is with the management. Basically, they have to prevent and detect fraud and error. They have to reduce the opportunities for fraud to take place. They have to communicate to the employees, provide them relevant training, identify what is the likelihood of fraud taking place, ensure reasonable controls are put in place. These are all the management responsibility. Auditor, what it has to do is, in accordance with the standards on auditing, he is responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. Okay, what he has to do is he has to maintain professional skepticism and remain alert that a fraud could take place. How will he know that a fraud will take place? Based upon the incentive, opportunities, and attitude. Consider the potential override of controls and the possibility that normal audit procedures may not be effective in detecting fraud, because the normal procedures that we essentially do, that is more so for detecting any irregularities, any errors. Fraud ke case mein, the management might have tried to kind of, layer that particular transaction. So what does the auditor have to do is evaluate what is the possibility of fraud taking place, inquire what is the management's evaluation on fraud risk, what does the management think, how strong are the chances of fraud can take place, check whether an internal audit function is there or not, because if an internal audit function is there, so less chances of fraud taking place. If an internal audit function is not there, more chances of fraud taking place. Inquire from those charged with governance, how they exercise oversight, how they ensure that fraud is not taking place, how do they ensure that the controls are working well, and consider the relationships between analytical procedures. Is point 4 we will explain at a later stage. If you think as an auditor that, boss, there is a chance of fraud taking place, first of all, use an experienced member in your team. Evaluate what are the accounting policies that are in use, whether they are in line with the previous years or not, and incorporate an element of unpredictability. So in terms of your sampling, do not just, touch base on higher amount of transactions. Go in for small transactions, take some sample of medium transactions, check those transactions where any third parties, related parties are involved. Check those transactions as well, so that you are covering a wide array. What happens when you identify fraud? Once the auditor identifies a fraud, they must correspond to the matter on a timely basis. Basically, what we do is, if we feel that the management involved, then we should talk to those charged with governance. If we feel that they are also involved, communicate with the audit committee. If there is a doubt on the integrity, we should take a legal opinion. Boss, what should be the course of action? Also see if we have to inform any third party in this case, maybe we have to report it to the authorities if there is any legal responsibility, for example, in case of a money laundering. And you have to check the impact of the fraud in your audit report.
So,
Hanji.
so like just like a general thing. So like we are doing like all these points, like reporting the fraud, and then where fraud takes place, like the incentive, opportunity, and attitude. So in all these things, like are there some things that we need to fully memorize, or we just need to understand them so we can write it in our own language? Like how does it go with this paper?
Okay. So in specifically AAA, there are a few audit jargons that you have to use. So a term such as a professional skepticism, that is something that should be there as a part of your answer. Okay. Similarly, obtaining reasonable assurance to ensure that the financial statements are free from material misstatements. These are the lines that I'll keep on repeating during the sessions. And when we start doing the question answers, I will specifically highlight and let you know, okay, boss, what are the key words that should be there in your answer. Okay, you cannot rote learn, you cannot memorize answers, even the questions will not get 100% repeated. But yeah, there should be some words in your answer which are required from a syllabus perspective.
Okay. And sir, one more small help. So like since we are like I went through the textbook, like there are a lot of concepts to cover. So if you feel that there is, so this particular concept you feel that okay, this is important, we need to be knowing this. So can you please mention it there so that we have that in mind that this is thoda zyada important. For example, like ISA 240, abhi sabka naam we have to remember that you have already said. Now under those standards, maybe there is one specific line. There are some like these, like where fraud takes place, incentive, opportunity. So such things we will need to memorize, right? So if something else like that comes up, if you could please mention.
I will do that. I will do that.
Perfect, thank you.
Okay. Of course, withdrawing from the engagement, we'll have to kind of check what are my professional and legal responsibilities under these circumstances. So for example, you've uncovered a fraud. What do we now? We report it out to the management. If we feel the management is involved, report it out to those charged with governance. We feel those charged with governance are also involved, report it out to the audit committee. Just also obtain a legal opinion, just in case there's any other authority that needs to be reported out to. For example, in case of money laundering, then obviously in your audit report, you will state out, this was the fraud that has taken place during the year. Also, if you feel that the fraud, earlier for me, the management was honest, but now I know that the management is involved in fraud. Okay. I again do not want to be associated with anyone who lacks integrity. So I will consider whether it is appropriate to withdraw from the engagement or not. Wherever legally permitted, I would want to withdraw or not be associated with people who lack integrity. Okay. Obviously, if I am withdrawing from this, I will discuss with the appropriate level of management. I will give out my reasons. Even in case if it is required, I will report it out to the legal regulatory authorities and withdraw from that particular engagement. Again, now this was the theoretical part. practically, if you talk about, it is very difficult for the auditors to kind of uncover fraud. Why I'm saying that is because, see, you can go ahead and conduct audit procedures. You will be able to identify the normal irregularities. You will be able to identify the normal errors that are there. But if the management has actually really well concealed those fraudulent transactions, then what do you do? We often, in the audit world, not just the Indian part, but all across, it says the auditor is not an aggressive dog. He's more of a watchdog as compared to a bloodhound. So that line is also written over here. So we are not very aggressive kind of guy. We just watch what all is going on and then express an opinion. So what exactly should be done? It's still a very debatable concept. Okay, how much can I not? So very clearly, I can easily say, ki boss, as long as you're doing the audit as per the standards on auditing, you are not guilty of professional misconduct. How do we ensure if, for example, I have done it and there's still, I am sorry, just give me one second. Yeah, sorry. So, let us say I've conducted an audit for any particular year, and after my tenure, a fraud has been uncovered, which was taking place in that year as well. How do we ensure that it was done as per the standards on auditing? Practically, I'm talking about. So, it's a very debatable thing from a practical setup. A lot of people, because of the public outcry and the media trials these days, the auditor will somehow get, dragged into these cases. They will say, give us, how did you not identify, show us your work and things and not. So the idea is that regular trainings should be done. The more experience you have as an auditor, the easier it gets for you to identify fraud. If when you guys start working, it's not that you look at a transaction and okay, boss, this is a fraudulent transaction. But more experience you guys get, the more chances are that you will be able to uncover fraud. At the same time, there's a separate line altogether. Okay, so we're right now talking about the normal auditors, but there is a separate line known as the forensic experts or the forensic auditors or the forensic accountants. That's a separate team altogether, and they are experts in terms of these identifying those fraudulent transactions. Okay. Their line of work is very interesting. It's very different from the job that we guys do. Like, we guys go in for the audit procedures, we check in the supporting documents. They might, hire private detectives. They might kind of follow anyone to see where they are going after the office hours. They might see, or, one such case wherein I was a part of the audit team and we were able to identify who committed that fraud was. Because of the watch that guy was wearing. He was from the finance team, nominal salary of 35,000 per month, and he was wearing a luxurious watch. So, that was a trigger point. But then again, how do you prove that he has done it? So once you're able to kind of identify, okay, boss, this guy has committed fraud, that's when you backtrail the evidences. Okay, what has he done? When was he present? At what time these transactions have taken place? Where, if he was in office or not. But that's more of an investigative line that comes into the picture. We also have forensic experts who basically, are kind of experts in this particular area, often take that help. And the beauty about, hiring big companies such as PwC, EY, etc., they all have these departments in place. So a lot of times, when we feel that there's a fraud taking place, what we do is we try to hire them, use their expertise in those areas, and it gets easy. The mediocre firms kind of fail in this aspect because they do not have that kind of an exposure, or they don't have those available resources. So it gets a bit difficult for them to identify fraudulent transactions. That's, the practical set of challenges that you have. essentially, you know, sticking to the syllabus. Just a quick recap: management's responsibility to prevent and detect fraud and error. Auditor will obtain reasonable assurance that the financial statements are free from material misstatement, whether by fraud or error. He will conduct audit procedures, maintain professional skepticism, and check for indicators of fraud. If there are indicators, he will kind of increase his audit procedures line of work. And if he's done the work as per the standards on auditing, he cannot be held guilty of professional misconduct. Any questions, doubts?
No, sir.
Chalo ji, perfect. Just give me a minute and I will be back. Okay. Some extra nice, case study parts. When we prepare the audit report, okay, who is it addressed to?
Shareholders.
To the shareholder.
To the shareholders, to the members. So that means my liability is majorly to the shareholders. Cool. Okay. Now what happened was, ki boss, essentially, my responsibility, my duty of care exists for the shareholders because to them I am giving out a audit report. Now think about, I was auditing one particular company. Okay. Now that particular company submitted the audited financial statements to a bank and obtained loans. Okay. So I was auditing one particular company. That company obtained loans from a bank by submitting the, obviously, the audited financial statements will get submitted. Every year, there was a clause in the loan agreement as well that every year the audited financial statements will get submitted. After a point of time, the client kind of stopped repaying those loans. He could not repay those loans. So what the bank did was they sued the auditor. It was because I relied on your audited financial statements. I did not see a problem coming in, and now my loan is not getting repaid. The question is, does a duty of care exist between the lender bank and the auditor? The bank relied on the audited financial statements. The audited financial statement did not show any signs of a fraud taking place or an issue to a going concern. bank relied on that set of statements and then continued with the loan proceedings. Now the loan is not getting repaid. Does a duty of care exist between the auditor and the bank? Vinita says no. Okay, what about others?
So on the date the financial statements were submitted, the auditor has given the report that they are fine. So the auditor can also not foresee the future, right? And if after that some extraordinary event takes place due to which the bank is not sorry, the client is not able to pay, then it like the auditor cannot be held responsible for it.
Okay.
Like I think so.
Every year, the audited financial statements are getting submitted to the bank during the course of the loan.
So, but maybe the management has hidden it in such a manner that auditor is not able to find it.
Not able to find it. Okay.
Yeah.
So the audit takes place on basis of sampling. So there are some inherent limitations to the audit also. So we, as we say, we give a reasonable assurance and not a guarantee. So I don't think auditors are like liable that after the opinion has been issued, if the something happens and the entity is not able to repay the loan. So as
Okay.
long as the auditor has performed their duties with all due care, auditors cannot be held responsible for that.
Okay.
Yeah, so we can't always say professional, we can't always say inherent limitations and escape, right? As long as you've not been professionally negligent, then I believe you will be safe. And you've done quality audit, then you're safe.
What if, the auditor was professionally negligent? Okay.
And if the litigating party is able to prove that, then you're on suit.
But my point is, there was no written contract between the auditor and the bank. So for me, the bank is a third party. See, what does the text says? Liability to the client arises in the any legal liability against the auditor. It will arise in case of a contractual arrangement executed with the client. The auditor may be liable in certain circumstances. Engagement letter acts as a contract between the auditor and the client. So in case of any breach of contract, the company may sue the auditor. Okay. Now this contract exists between whom? Me and my client.
Yes.
Okay. Who has suffered the loss in case? The bank has suffered the loss. Can the bank sue me? Because I don't have any direct contract with the bank.
Yeah, but the bank has relied on the opinion that you have given, right?
Okay.
I believe if he has suffered legitimate damage and by relying on your work, then I believe you are liable to damages.
Okay. I'll give you another example. We'll just put this example on hold. Another example is, let us say, boss, a person who is not a shareholder. Okay. So for example, I have invested in a company and I've suffered a loss on those shares. Now I sue the auditor ki boss, I relied on your set of audited financial statements. Maybe the auditor was professionally negligent, but I have sued the auditor. Okay, boss, I relied on your signature and invested in this company. Now I have suffered a loss. Do you think that claim will hold good in the court of law?
You mean to say from a minority shareholder's perspective?
From a
minority shareholder, maybe I own around 1,000 shares in a company.
Maybe a minority. Maybe I've invested a majority stake. It's either ways. But the point is, till now I'm not a shareholder. I invested in the company basis the audited financial statements and I suffered a loss. Maybe the auditor did not uncover a fraud. He did not do the testing properly or whatsoever reason. Okay. Can I still sue him?
So I think we can, because the opinion that the auditor issues, it says that true and fair view to the users of the financial statement, which includes a wide range of people. So I think the case would hold true.
Okay. So the correct answer is ki boss, in the second example that we gave, there is no duty of care. Why? Because the report was addressed to the members of the company. Members means existing members, existing shareholders. If
Right.
they rely on my report, suffer a loss, I am guilty, not any potential investor.
Mhm.
Okay, because there's no contract.
Right.
Whereas coming back to the first example, wherein the bank had relied on my audit report and continued with the loan facility, in that case, duty of care existed. I'll tell you why. Because even though there was not a written contract, but I, as an auditor, I knew that the bank will rely on the audited financial statements. It's a general understanding. It's no rocket science. It's very crystal clear that was banks will rely on the audited financial statements. Also, because I would have read the agreement. So if I'm auditing the liability, I'm auditing the loans of any particular company, I will obviously read the terms and conditions of the loan. And in those terms and conditions, it was clearly called out that the company will submit in audited financial statements to the bank every year. Okay. So because I knew there was a contractual agreement between the client and the bank, and as a professional duty, I should have gone through that contract. I should have known that was my audited financial statements will be submitted. So in the first example that we gave, a duty of care existed and the auditor had to kind of pay the damages. Both of these were real case studies. I'll just see where they are
So, but how
given.
does the scenario 2 differ from scenario 1? Because in that case also the investor relies on the opinion or the financial statements that the auditor has certified, right?
Absolutely, absolutely. He did. But there was no contract, either written or verbal, with that potential investor. Who
Okay,
do I?
one thing, just one thing, sir, because I as an auditor, I'm addressing the financial statements to the owners of the
To
company,
the
right?
owner. Yeah.
Right. So for example, for March 31st financial statements, the company releases it on June, let's assume. And basis that financial statements, I as an investor have invested in July. So you mean to say there is still a contract, right? The audit report is addressed to the owners. I become an owner once I invest in the company. Then
After.
how?
You became a owner after the audit report was issued. On the date of the audit report, when we issue the audit report, we date it and we sign it. On the date of the audit report, you are not the owner of the company.
Right.
So
Yes.
that means the report is not addressed to you.
All right. So that is the key point of differentiation. As on the date of report, I'm not a stakeholder. So
Absolutely.
okay, understood. Good. Thanks.
Okay. So when does a duty? Okay, I'll start from the beginning. Circumstances in which professional accountants may have legal liability in case a contract exists, that means between the client and me. So if, for example, I do not perform my duties very well, the client can sue me. If appropriate skill and due care is not exercised by the auditor, and the auditor is not able to validate that they have complied with the professional standards. So in these three cases, the auditor can have a legal liability. What about liability to third parties? Third party does not have a contractual relation with the auditor, but may, it's not says shall, it says may be able to sue the auditor for damages for the negligence. But the third party must prove the following, that the auditor owes a duty of care. So you have to establish, boss, the auditor owes a duty of care, the auditor breached the appropriate standards, and the third party has suffered a loss as a result of auditor's breach. Okay. When is the duty of care owed? The third party should prove that the auditor knew the injured party was likely to rely on the audited financial statements. Because in the bank's example, the clause clearly said that the audited financial statements will be submitted to the bank. That's why it was certain that the auditor knew that, the bank will rely on the audited financial statements. Accordingly, the third party has sufficient proximity to a class likely to rely on the financial statement. Obviously, banks, lenders generally rely on audited financial statement. The injured party had actually relied on the financial statements, and the injured party would have acted differently if the audited financial position statements would have shown a correct picture. So in the court of law, you have to kind of prove these 3-4 aspects, and that's when we can say a duty of care exists. These are the, the milestone case studies. First is the Bannerman case, Royal Bank of Scotland versus the Bannerman Johnson Macleay. RBS provided overdraft facilities to APC Limited, and Bannerman were APC's auditors. The relevant facility letters between RBS and APC contained a clause requiring APC to send each year a copy of the audited financial statements. In 98, APC was put into receivership owing money to RBS. RBS claimed due to fraud, APC's financial statement for the previous year had misstated the financial position, and Bannerman had been negligent in not detecting the fraud. RBS contended that it had continued to provide the overdraft facility in reliance for the unmodified opinion. Okay, so Bannerman applied to the court, striking on the grounds that even if the facts were true, जो auditor था, what did he say? He was, even if these facts are true, we do not have any contract with RBS, and hence we do not owe any duty of care. The judge held facts pleaded by RBS were sufficient in law to give rise to a duty of care, so the case should proceed to trial. The judge held, although there was no direct contact between Bannerman and RBS, knowledge gained by Bannerman in the ordinary audit work was sufficient to create a duty of care owned by Bannerman to RBS. Now, this becomes very tricky because, anyone can, rely on the audited financial statement. Any lender can come up and say, okay, boss, I have lost money because of the auditor. What do I do? So what auditors can do is to protect them from such liability is they can add a disclaimer in the audit report. So if I just add one line to the audit report, boss, this report is solely addressed to the members of limited. No duty of care is extended to any other party relying on the audited financial statements. If I add this disclaimer, then no duty of care will exist. But in the absence of any disclaimer, a duty of care will exist. Yes, Harsh.
Viewing from a general point, like in today's world, do companies usually address it to everyone, or they add this disclaimer that, this is not for any third party? Like, how do they do it?
Generally,
Yeah.
people have started kind of adding these disclaimers. Another aspect is earlier, they were firms, they were partnerships. Now, with a limited liability partnership concept has come into the picture. Earlier, because of partnerships, they had unlimited liability, but now limited liability partnerships have come into the picture. So kind of their liability has been restricted. You can use disclaimers. There's no hard and fast rule over there is, but the amount is how many disclaimers do you use? Because then your, credibility also goes in for a toss. If you add so many disclaimers to the audit report, the credibility will go in for a toss. So you'll have to be very cautious. But yes, definitely, yes, the audit firms have started using disclaimers. So the auditor may have a civil liability, may have a criminal liability. Civil liability basically is tax legislation, insolvency legislation, stock exchange regulations, these cases, civil liability. However, when the auditor is, let us say he was not eligible to act as an auditor, if there's a fraud scenario going place, if there's, let us say, a money laundering transaction going place, or possibly insider trading is going on, these are the cases where a criminal liability might also come in. So for example, if we talk about Satyam, PwC was banned to conduct any statutory audit in India for a period of 2 or 3 years, and the partners who had signed on those financials were put inside jail. So that's a criminal liability. Some methods in which you can manage your exposure is, first of all, maintain the quality of audit, ensure that you comply with all the professional standards, all the auditing standards. Second is you can add in disclaimers of the liability. Okay, but then again, your credibility also goes in for a toss. Third is you have a liability limitation agreement. So when I'm entering into a contract, when the terms of engagement are getting signed on, in that itself, I say, ki boss, my liability is restricted to this particular amount in case of any gross negligence. This, of course, will be approved by the shareholders as well. Also, you can go ahead and take an insurance. So we have the professional indemnity insurance, we have the fidelity guarantee insurance. A lot of these companies, especially, with the high charges that have to be paid in case of a negligence, they go in for an insurance, and ultimately the insurance companies bear that particular loss. Anji, any questions, doubts in this? So I think, yeah, that's about it from my side. We haven't completed this particular chapter. We'll take it up again in the next session. Of course, there are a lot of other aspects to be covered in this particular chapter. But I thought this was a small concept, and I thought this was very interesting as well, to kind of understand or assess in which case duty of care exists or not. That's about it. Any questions, doubts, feel free to stay back in the session. Others, have an amazing week, and I will see you guys next Saturday, same time.
Sir, I
Thank
just
you, sir.
wanted to
Bye, sir. Thank you, sir.
so just to confirm, we have completed the first, second, third, fifth, and sixth chapter, right?
Sixth
Fourth
is
one, matlab we have partially
We've-
come. Fourth
correct.
one we will do later. I
Yeah.
think so.
Sir, can you just
But fairly long, so it will take the full session.
can you go back to the PDF? I just want to see till which page we completed, please.
Sure. '84.
And also, sir, can you send the PDF, please, today? I wanted to take a printout tomorrow, actually. So that
It's been shared on the group.
it has. Oh, I'm not added on the group, actually.
Not added on the group.
No, I sent a message to my, what do they call it? Supervisor,
Enter.
mentor, yeah, mentor.
Just drop in your
You
number.
can download it from the app. You have to download it on your mobile and then you can download it there. I did the same.
From the website, you mean?
No, mobile app.
Okay. Okay, Zell mobile app, you mean?
Yeah.
I don't use that. But okay.
I'll just share it in the Zoom chat. You can download it from there also.
Okay, thank you.
Bye.
Hello.
Yeah.
Yeah, sir. So sorry to disturb you and ask you the same question again. But I just wanted to know the which chapters that were covered in today's lectures, like the number of the chapters that were covered.
Okay. So till now, from yesterday till today, 1, 2, 3.
Because I couldn't refer to the books.
Okay. 1, 2, 3, 5, and 6.
Okay, these are done, right?
Correct. Okay.
Okay,
6
sir. Thank you so
is
much.
still in the middle. 6th, we still have to kind
Okay.
of cover the other concepts, but for reference, you can consider that.
Okay, sir. And sir, according to you, by before the next lectures, when we start, we should go through and make notes for the following lectures, right? For a
Following
better understanding of lectures.
only the part that we've covered.
Okay, sir. Okay, sir. Thank you
Okay.
so much.
Most welcome.
So just a question, like for the AAA subject, is it necessary to make notes as a such? Because like we already have a material, right?
Yeah.
Which we can
You
refer.
can rely on the summary notes. Yeah.
Yeah, and the answers are also very general, like they're not like for suppose like SBR, we have to know what the standard is, what it covers, and all of that. So notes are needed for such a subject, but audit is like more of a general subject, so it's not needed as such, no.
Yeah, you don't need notes, but yeah, the answers, we'll talk more about how to answer that particular question when we start with the examination kit.
Okay, so it's not like needed sort of like
Yeah,
for
it's not
note.
needed.
Okay, yes, thank you so much.
Most welcome. So Vatsal has shared the book over here. You can just download it.
Sir, when we are going through the notes, what extent should we revise? I mean, to what extent should we learn? Like, should we be rote learning, or do you think just reading the notes is enough?
For now, just start reading part. No rote learning required as of now. I will repeat the concepts which are very important, which get tested. And once we start doing the Q&A part, that's when I'll kind of draw your focus. Okay, boss, what is exactly that is required to answer?
Okay.
Perfect, sir. Thank you.
Most welcome.
Thank you, sir.
Nanji, I am ending the session now. All the very best, and I will see you guys next Saturday.
Yes, sir.
Thank you, sir.
Have a good
Bye-bye.
week.
Bye
Bye-bye.
bye.
Bye, and
Thank
thank
you.
you, sir.
Bye.